On behalf of CrossCheck Media and This Talk Today TV, welcome everyone to the Money Path. I'm your host, Todd Schoenberger, and joining me today is Aquiles Larrea. He is the founder and CEO of Larrea Wealth Management. Achilles, we had past couple of trading sessions, quite a bit of volatility. The president on Friday talks about, quote, massive tariffs on China goods and on China imports, and thus sent stocks reeling. And then he comes out and says, we're going to be just fine, and then stocks rallied. Investors want to know, Achilles, are we going to be just fine?
Yeah, we should be fine. And this is what I alluded to before. Every time, this man speaks, the president speaks, if you look back at when Greenspan said those words and moved the markets, that's one thing. President seems to have the similar effect, what's going on in the markets. We call it in the business moral suasion, where they try to influence different market segments and the like, sometimes to a positive, sometimes to a negative effect. But I gotta tell you, Todd, I was in there this morning buying on the dips, and every time I've ever done that in my career over 30 years, I gotta tell you, it's worked out great.
That's great. Well, buying on the dips today, you're definitely that was very smart. Chairman Powell came out and just recently, within the last hour, talking about how the tightening policy looks like it will indeed be ending, only because the labor market continues to crumble. And with that said, stocks are actually S&P's trading at the daily highs actually of the day. So my question for you though is that you have a big meeting that's coming up at the end of the month with the Fed, with the FOMC. They need to determine what's going to happen with interest rates. But you still have this government shutdown. Do you anticipate the government shutdown lingering? If it does linger longer, will that have a negative impact on GDP for the fourth quarter?
Well, I don't see how it couldn't. I mean, we have a lot of unemployment. Powell was alluding to unemployment rising, and therefore that's spooking the markets. It's also something that it's going to continue on their quest to lower interest rates further. They don't say it outright, but it's kind of expected. And even though we have this shutdown and they have a lack of data from labor, from the Bureau of Labor Statistics and the like, we are still seeing them on track to lower interest rates a couple of more times before the year's out, and then again in 2026, at the beginning of 2026. I don't see that changing unless there's some huge empirical data that states otherwise. As a matter of fact, I think it's going to bode well for the market because this is kind of what we've been expecting at this point.
So you're suggesting that a further government shutdown is actually a benefit because we're not receiving the data points, or it's just because they're just not there because then it's going to force the hand of the Fed to cut.
Well, I'm not saying that a shutdown is good. All I'm saying is that it affects the numbers that are coming out for the Fed to make a decision. So, a shutdown, a prolonged shutdown, is not good for our economy whatsoever. And the worst thing that, and I might have mentioned this the last time, the worst thing is that it throws us into a recession where we have that negative GDP for 2 quarters. And, we could easily see that, combination of inflation, combination of higher unemployment, that may spook the markets eventually, but not at this particular moment. It is going in line with what the markets were thinking, and that's why we're starting to see movement towards the upside.
That's right. And you're referencing the last time you were on the money path a couple of weeks ago, and you did bring up recession, and you did say that that could be a slight risk as far as something that we just need to keep our attention on. But what are your thoughts now? Because there seems to be a lot of retailers now are now coming out with warnings for the holiday shopping season, thinking that we may have a slowdown in holiday spending. Then you obviously have the labor picture as what you were just mentioning. Do you think going into 2026, though, do you see a rise in the risk for a potential recession?
You know what? That's an interesting question without an easy answer. I mean, there are a lot of factors that go into a recession. And Todd, half the time we have a recession, it's not like it comes up on the door, knocks on the door, and says, "Hey, I'm here."
Right.
What happens is that 6 months go by, the recession happened, and you didn't know about it. So the
That's
factors
true.
are there for it to actually happen, but whether it's occurring right now is anybody's guess. What I do see is with these numbers that are coming out, that we are starting to inch towards that direction. I don't I fear it's not a long, protracted thing, but I'm more concerned rather than a recession, I'm more concerned about stagflation right now. And that's the thing that I think everybody should be concerned about. That if it gets into the markets, we could have a prolonged stagflation stage. And that's a big thing to worry about.
Now, are there any particular investments or themes that investors may want to take a look at if we do end up in that stagflation period?
Yeah, when the markets go down, I always go back to the stuff that works, and that means growth and dividends. So if you're looking for some, not necessarily a safe play, but if you're looking for something that's high quality, you may already have it in your portfolio, but it might be time to accumulate it again. Companies like Philip Morris or Altria Group, shall we say, companies like AT&T, in spite of the network and the things that are going on with that, we see solid dividends. We're looking at between 6 and 7%. So if the company, better said, if the company goes up, let's just say for argument's sake, they go up 10%, you've made 17% on the year, and
Ooh.
nobody's going to be mad doing that. So it's just a safe haven, where money will gravitate towards the high quality names. You might go back to Microsoft, Todd. Microsoft reinvented themselves by going back into, going into AI and really putting a play there. I mean, they hired a guy to hang, because AI needs a lot of energy, and it's nuclear. They hired basically a rocket scientist, a nuclear scientist, to head up that division. So that way they have plenty of power for their AI driven strategies, core strategies going forward. You also want to be in any infrastructure plays. I might have mentioned John Deere or Caterpillar the last
Yeah,
time.
you did.
I'm sticking with that because in absence, we still need, and we have already funded the bills to build more infrastructure,
Hmm.
bridges and roads here in the United States. That bill was passed last year. So, that it's already funded. So they're not losing any more money. Now, the question becomes with all these companies that I've mentioned, Todd, is there growth? Is there possibility for more money to be made? And that's one of those things I got to say, you know what? Stay tuned. Let's see what happens.
Yeah, no, I agree with you, and I love the outlook on the dividend-paying companies. I think that gets overlooked, especially when you have high growth periods, such as seeing the Mag 7 companies do so well. We lose the focus of receiving that quarterly dividend. One final question for you. As we have 2 months now till Christmas. The holiday shopping season is full effect. I was watching the Georgia Auburn game over the weekend, and I saw countless commercials for Christmas. What do you, I mean, from a retail perspective, I know the retailers are coming out with their warnings, but it's still a sweet time to get in and start investing in those retail companies. Is that an area or a theme that you would focus on for your clients, or do you think they should just stay on the sidelines?
No, never on the sidelines, but I am not a big fan of retail.
Hmm.
And I'll tell you why. All right, retail is very cyclical. Retail, although we're heading into the black for a lot of retailers right now,
Hmm.
that doesn't really mean anything, especially if they've been so far in the red, that they're only coming back now. On the one hand, yeah, I can make some money, because it's been downtrodden per se. And then on the other hand, it might stay flat and you only make 2-3%. And that for me is an underperformance, and I just can't have that in my portfolio. So we stay away from that. We want growth, we want consistent growth, we want dividends, we want in the portfolios high quality. And although a lot of retailers have made significant gains in some areas, we feel that there's just a lot of uncertainty, especially if they're guiding downward. you know yeah, I don't know if I want to jump into that just this particular moment. And honestly, it's a sector we tend to shy away from.
Okay, well, that's sound advice. I mean, that's great. The audience wants that, and they love that type of conviction attitude. So I think that's awesome. So that's great, Achilles. So Achilles, thank you for joining me today. I know we have you coming up on, I think on buy, hold, sell coming up maybe next week or the week after. Can't wait to have you back. I'm sure we're going to be talking a little bit more about these volatile times.
My pleasure, Todd. Thank you again.
Absolutely. So coming up tomorrow live, we have Shanna Sissel. She's going to be joining me one-on-one live. And then Bob Dole is going to be joining me on Thursday for a one-on-one exclusive. Definitely want to take part and watch both of those episodes. So on behalf of Aquiles Larrea, I am Todd Schoenberger. Thank you once again for joining us on The Money Path. We'll catch you next time. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.